Hello everyone, I am Varun.m2p from Varun.m2p Review, and now we shall discuss a very interesting concept in fixed asset accounting, which is called impairments. In real life, impairment is a disability, so it's similar for fixed assets. It means that they will not be able to recover their carrying value during the course of their remaining life. The simple concept of impairments is made slightly complicated with different sets of rules for tangible assets and intangible assets. With intangible assets, we have rules for held for use assets and held for sale assets. And intangible assets have different sets of rules for definite life and indefinite life assets, which of course includes goodwill. Now, there's a little more spice. From 2011 onwards, the CPA exams include IFRS, which means that for every section we learn the US GAAP rules, we also need to understand the IFRS rules, mainly the differences between the two, because whatever isn't different is similar. But don't you worry, I'll make sure that the financial and reporting part of the CPA exams is a cakewalk. You just have to understand the larger picture, nail the concepts, and remember a few mnemonics. And in a few months from now, you'll be proud to be a CPA. In impairments, the first question we need to ask is, has the value decreased? With the camera right there in front of me, I can't think of anything but a company producing camera reels, let's say Kodak. Now, we all use digital cameras these days. The demand for reels has significantly fallen as compared to a decade ago. Maybe only people who have those old reel cameras and don't want to spend on the new digital cameras use them. Let's say the carrying value of the machinery producing camera reels as of December 31st, 2010 was $100,000. Now, the management depreciated that machine for, let's say, $20,000 to get to a balance carrying value of $80,000. Now, the management is aware that the demand for reels is low and the machine might not be worth its carrying value of $80,000. So we do a test for impairment where we compare the carrying value with the non-discounted future cash flows. Guys, this is a very critical part. Remember, non-discounted future cash flows. The management maybe estimates that the future cash flows over the next 5 years from this machine is $10,000 per year. So the test for impairment is the carrying value of $80,000 greater than the non-discounted future cash flows. That's the $10,000 per year into 5 years, $50,000. Yes, $80,000 is more than $50,000. So our machine is impaired. We now proceed to measure impairment. Now the management estimates that the fair value of the machine is $30,000. Guys, note that the fair value is based on discounted cash flows. So it is generally less than the non-discounted future cash flows. Our amount of impairment would be the $80,000, the carrying value of the machine, less the fair value estimated $30,000, that's $50,000. Where do we recognize it? It is recognized in the C or D of our income statement. The C stands for the income from continuing operations, whereas the D is our discontinued items on our income statements. So if the machine is part of our continuing operations, we'll get it in C, and we learn in held for sale assets that it goes to D. Now let us just step back and understand what could be the reasons for impairment. Decline in demand. The demand for reels has substantially fallen. Inability to keep up with technology or competition. The camera reels are certainly unable to compete with digital cameras. A decline in the fair value of the asset. A net operating loss or a negative cash flow of the unit. It could also be a negative change in regulatory or legal environment. Let's take a hypothetical case where the government something gets onto its head and says, we ban camera reels. It says everyone use digicams. For goodwill impairment, there could be other reasons like a loss of key personnel, the CEO of a company is no more, or impairment loss by a subsidiary because whatever is down may flow upwards. So these are the key circumstances that indicate impairment, after which we test for impairment, we then measure it, and after the measurement, we recognize it onto our books. The asset in our example, the machine producing camera reels, was a tangible assets and it was held for use. So let's quickly fill in the blanks. Do we depreciate or amortize it? Yes, we depreciated it by $20,000. What is our test for impairment? was whether the carrying value is greater than the non-discounted future cash flows. I repeat, please note, it's a non-discounted future cash flows. What was our measure for impairment? We did a carrying value less the fair value. Note that for testing we used non-discounted future cash flows, whereas for measuring we used the fair value, which could be as well the discounted future cash flows. We recognized it in C because it was part of Kodak's continuing operations. They were not planning to sell the machine. In this example, now let's consider that the Kodak management has decided to discontinue the reels business and sell its assets. So the asset gets classified as a held for sale assets. Do we depreciate held for sale assets? No, we do not. What is the test for impairment? Its carrying value is greater than the NRV, which is the net realizable value, that's equal to the fair value less cost to dispose. Good thing here, the measurement is the same. If the carrying value is greater than the NRV, we simply have the carrying value less NRV as our measure. We recognize it in the D of our income statement. Now let us also consider an option of future write-up. Let's say we recognize impairment for a particular asset, but the value goes up again in the future. What do? In US GAAP, we cannot write up the value for held for use tangible assets, but we are allowed for held for sale assets only. For IFRS, you can write up the value of an impaired asset which goes up anytime. So it's yes and a yes for both. Proceeding to intangible assets, we first have definite life intangibles, like a patent with a remaining useful and legal life of say 10 years. Now, definite life intangibles are amortized over their remaining useful life since their useful life is definite. Now, testing, measurement and recognition norms for definite life intangibles are very similar to held for use tangible assets. So, our test for impairment would be, is the carrying value greater than the non-discounted future cash flows? The measure would be the carrying value less the fair value. Recognize it in C if it's continuing operations, or D if it's a material discontinued item. Future write-up, again, it's the same. US GAAP says no, IFRS says we are fine with it. For indefinite life intangibles, like a trademark, it's going to be there for a very long time, but we do not know for how long. Guys, note that indefinite life intangibles do not mean forever. It means we just don't know their useful life. And because we do not know the useful life, we can't amortize. Guys, nothing is clear on these indefinite life intangibles. They are generally unidentifiable and cash flows from them are very difficult to segregate. Now, since we are unable to ascertain the future cash flows, our test for impairment is also the carrying value greater than the fair value. The measurement is the same as definite life and recognition is also in C if it's a continuing operations, D for material discontinued. Future write-up, no for US GAAP, allowed for IFRS. Now the last part of our chapter of impairments is goodwill. Goodwill is also an indefinite life intangible, just that its test for impairment is different and slightly lengthier than other indefinite life intangibles. Now, as we know, goodwill makes the business more than the sum of all its identifiable assets. The cost for goodwill is capitalized only in case of an acquisition, where goodwill is the difference between the amount paid to acquire a company less the fair value of all its assets adjusted for liabilities. Now, as for other indefinite life intangibles, we do not amortize goodwill. Now, there are two steps for testing goodwill impairment, where test 1 is the carrying value of reporting unit with goodwill greater than the fair value of reporting unit, again with goodwill. After we're done with test 1, we do test 2, where we test if the carrying value of goodwill is greater than the implied fair value of goodwill. Now, the carrying value of reporting unit with goodwill is the same as the shareholders' equity figure on a balance sheet, which is compared with the fair value of the reporting unit. Now we could get it appraised, we could measure it as a multiple of earnings or a multiple of revenue. Then we move on to test 2, where we use the carrying value of goodwill. Again, that's the figure of goodwill on a balance sheet, which is compared with the implied fair value of goodwill, calculated as the fair value of reporting unit with goodwill we had in test 1 less the fair value of all the assets adjusted for liabilities. The measurement for impairment and the recognition is the same as other intangible assets. Now, let's have a few quick takeaways from this table. For testing impairment, we use undiscounted future cash flows, but we use fair value or discounted future cash flows for measuring impairment. However, undiscounted future cash flows do not apply for held for sale assets and cannot be estimated for indefinite life intangible assets, including goodwill. So in those cases, we use the fair value also for testing impairment. Now, one last thing is US GAAP does not generally allow write-up of impairments except in case of held for sale assets, but in IFRS we are allowed to write up for impairment losses. Now guys, I think with this table on the board, it's got a lot of data, it's also there on your book. The impairment topic should be as simple as a pie. All the best.